Hey everybody, welcome back to the Truth About Real Estate Investing YouTube channel. My name is Chris Hook. I'm one of the coaches on the iWin team. Today I wanted to quickly talk to you about what happens to real estate when interest rates go up. So interest rates are a huge topic in the market today. We are expecting announcement from the Bank of Canada sometime this week with regards to an interest rate hike potentially. So I just wanted to quickly touch upon what that interest rate hike might mean to you as an investor or you as anyone looking to purchase real estate. So before I go into that, I just wanted to quickly touch upon the interest rates and what we're talking about when we're talking about interest rate hikes. So there's two main, obviously, interest rates that we look at from a real estate perspective. The first one is your fixed rates, which are really determined by bond market rates. And then the second one is your variable rates. So the variable rates are the more common ones. They're obviously a little bit more popular because if you're looking to, get out of a transaction, out of a mortgage, there's less of a penalty in doing so. So the reason the variable rates are the ones I'm going to focus on is because whenever we hear of a Bank of Canada interest rate hike, they're really talking about the overnight lending rate, which directly influences your variable rate mortgages. So just to kind of clarify between those two, if we currently look at what the interest rate looks like and how that impacts your current monthly payment, I want to use that as my first scenario, and then I've got 3 or 4 other scenarios that I quickly want to touch upon just to kind of explain the point with regards to how the interest rates will impact the market. So in our current state right now, if we assume a purchase price of $1 million, I'm just going to use round numbers. So let's say $1 million, down payment of 20%. So that would be a down payment in terms of dollar amount of $200,000. So your mortgaged amount would be $800,000. Current interest rates are in and around 2%. A lot of people are getting less. Some people are getting a little bit more. But for the most part, on investment properties, they're in and around 2%. You're getting a little bit less on a primary residence purchase. So assuming an interest rate of 2%, amortization period of 25 years, the monthly mortgage payment right now that you'd be paying is $3,391 per month. So let's use that as our starting point. When I look at scenario number 1, I'm going to again use $1 million purchase price so that it's constant throughout the different scenarios. I'm going to also assume again a 20% down payment. So again, $200,000. Let's assume that the interest rate goes up 1/4 of a point. So typically when interest rates go up, they either go up 1/4 a point or 1/2 a point. In my opinion, I don't think 1/2 a point would be realistic at this point. 1/4 point likely makes sense. So let's assume 1/4 of a point. So 2.25%. Amortization period again is 25 years. Monthly payment for that would be $3,489 per month. So when we compare that number to the current state of $3,391 per month, that's only an increase of $98 per month. So I ask you, do you believe that that's going to really have any impact on the real estate market? My opinion, it might have a little bit of an impact, but I don't believe it's going to have any significant impact on the real estate market. That $98 per month, that equates to $1,200 per year. So if you think about that, if you're a Starbucks drinker and you're doing a $5 drink 5 days a week, that's your $1,200 right there. It's actually a little bit more than that. So, as someone looking to purchase real estate, would you forego your Starbucks in order to be able to purchase a real estate asset? I think in most cases, the answer to that would be yes. So the other scenario I want to talk about is, let's assume that you have a little bit of equity built up and you're able to put more down than just the 20%. So let's assume that you have a purchase price of $1 million again, but instead this time you decide to put down 22.5%. So now you're going from a $200,000 down payment to a $225,000 down payment. Again, we'll assume the same interest rate of 2.25%. Same amortization period of 25 years. Your monthly mortgage payment in this scenario is actually $3,380, which is the same as what we're currently seeing right now. So I think in a lot of cases, especially with those that are able to afford that additional amount of $25,000, I know a lot of real estate investors have built up a lot of equity in their homes, so they definitely have that $25,000 available to them to be able to invest in a property. That might be the likely scenario that people will end up putting more down. So again, I don't believe that either of these two scenarios is going to really have any significant impact on the real estate market right now. Now let's talk about scenario 3 and scenario 4. So scenario 3 would be if the interest rates were going to go up a 0.5 percentage point. And now my assumption here is that you're going to have a 1/4 percentage point in the near future, and then you're going to do another 1/4 percentage point a little bit later on in the year. In that case, you'd be now at 2.5% as your interest rate. So again, same scenario, purchase price is $1 million. Down payment is 20%. So you've got a $200,000 down payment. Your interest rate is 2.5%, as I mentioned. 25-year amortization. Your monthly mortgage payment now goes up to $3,589 per month. So now you're looking at a $200 increase per month. So again, in that scenario, you're looking at $2,400 per year. I don't think that it's going to have a significant impact on people. If you think about an individual that's making $100,000 or a household that's making $100,000 a year, your typical salary increase on a yearly basis is anywhere between 2 and 3%, depending on the organization that you work in. So let's just assume at the lowest level of that, at a 2% increase, you're looking at $2,000 per month that you would receive, $2,000 per year. So that would most likely offset your scenario where interest rates go up 0.5%, and it's going to definitely offset your scenario where your interest rates go up only 1/4%. Again, all of your other goods that you're going to be purchasing as well are going to go up in price. So there's going to be inflation on that particular that stuff as well. But from a real estate perspective, I feel like people will likely scale back on those other items in order to be able to afford a piece of real estate if that's what they really want to do at the end of the day. Remember, keep in mind that the interest rates, the reason they're looking to raise interest rates is they feel that inflation is getting too out of control. And they don't want to get to the point where, back in the 80s where we had inflation of, 20%. They want to try and avoid that. So what they're going to try to do with the interest rate hikes is to really slow the economy, slow the economy a bit. So raising it too quickly will do the exact opposite of what they're looking to try and do at the end of the day, which is try and keep a steady state economy going. So the last scenario I want to talk about is scenario 4, which is where, 6 months ago, 3 months ago, Scotiabank came out with a statement that, they were looking to raise interest rates anywhere between up to 8 times is what I heard. So think about that from where we are currently. It would basically double where we're at from an interest rate perspective. You go from 2% to 4% over a short period of time, over an 18, 24-month period, which is a lot. My example that I'm going to use here is going to assume 6 interest rate hikes at 1/4%. So your total interest rate will go from 2% to 3.5%. Again, purchase price is $1 million, down payment of 20%, which would be $200,000. 25-year amortization. Your monthly mortgage payment now goes to $4,005 per month. So that would be a $600 increase, $614 to be exact, over current state of 2%. So that is quite a bit of a significant increase. Total over the year would be $7,400. When you think about that, family of 4, that'd be a vacation somewhere. So you're going to kind of forego your vacation to live in a home. As an investor, $600 a month, that's a lot of money to cover off from a cash flow perspective. In some cases, it's still manageable, given that rents are increasing as well. But it's much more difficult to find cash flow properties with that size of an increase. So that scenario to me is a highly unlikely scenario. Never say never, but it's always a possibility. But I just don't believe, given the amount of debt that all these governments are carrying, we're very debt laden society right now, that raising the interest rates to that level, I think, is going to cause more harm than good at this point. The only other thing, so at the end of the day, my quick answer to the question on what what happens to real estate when interest rates go up. The answer is it really depends. If we're seeing a quarter point or a half point percentage increase, it's likely not going to have that much of an impact. If we start to see more hikes down the road, then yes, I think that will certainly have an impact. But at the end of the day, to me, in terms of real estate, the biggest challenge that we face right now is supply, and I don't think that I don't think that that's news to anybody. I would say that until we solve that issue of supply, we're still going to continue to see housing prices either remain flat or continue to increase. In 2016, Canada changed their policy for immigration to allow to basically turn over the workforce, an aging workforce that they wanted to kind of bring in more immigrant students into Canada to kind of, they're ultimately going to be the people that will drive the economy in the future. So as a result of that policy change, we saw immigration increase quite significantly. We haven't seen the supply of housing increase at the same rate. There was a task force in Ontario that recently just mentioned that we need about 1.5 million more houses over the next decade in order to meet the demand. Currently in Ontario, they're building about less than $100,000 new starts are occurring every month. So it's going to take us a while in order to be able to meet that demand that's currently out there, because there's just really not supply. And I believe at this point that's really the driving factor of what's causing the prices in real estate to go up. I believe that the interest rates are a temporary factor that may or may not have some impact on the real estate market, but there's really other factors going on that is causing the prices that we're currently seeing today in the market. So hope you found that helpful. Please hit the like button if you did, and we'll see you next time.